Hey everybody, welcome to the 40 Finance channel. My name's Jeff Beers. Today we're going to look at 3 quality stocks that are on sale in my opinion and determine if it's the right time to buy the dip. So let's dig in. First stock on our list today is the FedEx Corporation, currently trading at $179 per share. You can see on this 1-year chart that FedEx has been blasted over the past 12 months, but most recently they've been hammered in the last couple months. FedEx was as high as $260, $270 last year. They went down a little bit as the year went on. Obviously, the stock market across the board dipped in December. But then they came out with some fears about the China trade tariffs and whether or not that would affect global shipping. And everybody spooked out. FedEx dropped somewhere in the neighborhood of 150, somewhere in there. It's bounced back ever so slightly. But the fundamentals, in my opinion, on FedEx are very impressive. You have a current PE right now of 9.76. The forward PE goes up ever so slightly to 10.01. And really what you have here with FedEx is a phenomenal company. Everyone's been a little spooked about the growth story. Would Chinese tariffs and everything related to trade bring down their earnings? I think the answer is that's a fear that is overblown. And with FedEx, if you buy and hold for the long term, I think you get in now while it's on sale, P ratio of 10. It also has a dividend of 1.46%. There's nothing in my mind that is a major threat to FedEx, right? Shipping isn't going away, all right? E-commerce isn't closing. FedEx is not running out of money. It's a rock solid company that's taking a dent on earnings forecasts for the near future. I buy and hold this stock all day long. Looking at what other analysts are saying about FedEx over the next 12 months, you got an average of $222, which is almost a 25% upside projection. Get into FedEx for the next 2 to 5 years. Don't touch it. Just let it sit there. Get your dividend. It's really hard to imagine a scenario where you're not going to be in the money in the longer term with a fantastic company like FedEx. Next on our list of stocks on sale, I have the Raytheon Company. The Raytheon Company is a defense stock. So they make a lot of equipment around missiles, missile tracking. They also do cybersecurity and various other defense-orientated services that they sell to the US government and other governments as well. You can see over the past year, they've fallen from a high somewhere in the neighborhood of 225, and now they're down to 168.70. My opinion right now is you get a little bit of a spook from the government shutdown that lasted so long. I feel pretty good about that stuff in the long term. I think politicians know that the security of our country is very important. And I think Raytheon is already a trusted vendor for the United States. Right now, you got a P ratio of 1663. That actually drops over the next 12 months, projected to go down to 1443. They also have a dividend of 2%. And I just feel good about the prospects of this company going forward. Taking a look at how analysts see Raytheon over the next 12 months, you got an average price target of 201. Today we're at 168. That's about a 20% upside, depending on who you look at. You've got a high of 221 and you got a low ball of 175. So landing in the middle at 201 feels like a pretty safe place to project over the next 12 months. And just like FedEx, go into this with a 2 to 5 year mentality. You're not going to live to see Raytheon go out of business. They're always going to be in the conversation of defense. And I just think that it's a tried and true company that at the worst case scenario, you get some dividends in the short term, and in the long term, defense spending by its nature only goes up because the technology increases, and Raytheon is right at the center of that. All right, last stock on sale for today is Constellation Brands, ticker symbol STZ. Constellation Brands makes literally hundreds of wine and spirits brands. They also have some beer brands like Corona. And most notably for Constellation in the short term is they have become an investor in Canopy Growth, which is obviously one of the hot marijuana stocks that are out there in the market today. So I feel like from the standpoint of the adult beverage and entertainment category, Constellation is in a very good place. However, over, let's just call it the past 3 months, they've really taken a dip. There's a lot of fear about wine and spirits in the marijuana era, if you will, okay? So a lot of people think that if and when marijuana gets legalized here in the United States, that it'll put a massive dent into the beer, wine, and spirits industry. I feel like that is a scenario that is probably a little overblown, in my opinion. I think everyone has their preferences for how they like to socialize and what they like to hold in their hand at parties and gatherings. While there might be some concern for that scenario over the very long term, call it 5 to 10 years, I don't really think with Constellation Brands' assortment of brands and their reach in the market, I think what we're looking at right now today is a temporary downturn. And as things spring back into warm weather, summertime festivals, etc., I think sales go back up. The PE ratio for Constellation actually does go up. It's currently at 10.91, which is phenomenal. It goes up to 17.96. Most of that is because they just injected $4 billion into Canopy Growth. But overall, I just see a lot of potential here for a beaten down stock. Again, we're not necessarily looking for record earnings with beaten down stocks, right? We're looking for ones that have dropped too far. Can we make money for them just to return to par, if you will? And that's what I see right here. As far as other analyst targets go, I'm seeing an average of $217 for the best performing analysts. That's a 25% upside over the next 12 months. You have a high target of 265 and a low ball of 162. If you get this stock today, while it's a little beaten down, and plan on holding for the next 2 to 5 years, I feel very good that the returns will be strong, somewhere in the neighborhood of 20 to 25%. Guys, the average return these days, right, in the stock market is 8%. So if you're pulling on 20%, you're doing pretty good. This company isn't disappearing, okay? They're not liquidating. This isn't Toys R Us here. This is a monster company. So is FedEx. So is Raytheon. These are the easy wins to take advantage of. All right, hope you enjoyed this look of 3 stocks on sale. Please subscribe and share the channel with your friends. I'll see you on the next video.